Hello everyone and welcome to our presentation. Today we will be discussing chapter 10 of Intermediate Accounting 1 about acquisition and disposition of property, plant and equipment. And enjoy the video. Okay, let's begin with the definition and characteristic of property, plant and equipment or PPI in short. PPI refers to tangible assets that are held by a company for three main purposes. First, is used in the production or supply of goods and service. Second, rental to other, and the third is for the administrative purpose. There are three key characters that distinguish PPI from the other type of asset. One, they are accurate for use in operation, not for sale. Unlikely the inventory, these assets are meant to be used within the business, and then they are long-term in nature and except for land are usually depreciated over their useful life. And then the last is they are possess physical substance, meaning you can touch and see them, unlikely the intangible asset such as patent or copyright. Now, what costs do we include when we first record an asset? We use historical costs. That means the cash price to buy the asset plus all the costs to get it ready for use. These costs included the purchasing price after discount, import duties and tax that cannot be refunded, delivery, handling and installation, and professional fees and site preparation. So we only record the asset if the cost can be measured reliably and the asset will be future benefit to the company. In short, including all necessary costs to make the asset ready. So uh, we only include all the costs that make ma make the asset is ready. Okay, now let's talk about the land. When a company buy a land, all costs to buy it and prepare it are added to the land's value. This include the purchase price and closing costs, likely the title fee, cost to grade, fill, drain and clear the land, any back tax the company take over, permanent improvement like landscaping. For two special case, if the old building must be removed, the removal cost is added to the land cost. And if improvement that do not last forever, like fence, driveway, and parking lot, it go into the separated account called land improvement. Those are have a depreciate and like driveway, park lot, fence, it can be depreciate. But the land is not is not be able to depreciate. Okay, now building and equipment. For building, capitalized costs included material, labor, and overhead during construction, professional fee, and building permit. But do not capitalize startup costs, promoting costs, and early operation loss. Those are expense, not a cost. And for equipment, capitalized costs included purchase price plus freight and insurance while in transit, special foundation, assembly, installation, and trial runs. The main rule in the main rule is the same for the both, either for the building or the equipment. So it includes all costs to get the asset ready to use and expend anything else. outside the cost needed to make the asset ready to use. Okay, last one. What if the company built the asset for themselves? So you add direct material and direct labor. Easy, right? And what about the overhead? First way, only add variable overhead. The costs that go up because the project. Second way, it's better. Add a share of all overhead. But don't be crazy. You cannot add waste or mistake. Record more than the asset is worth. So you must record it in a fair value. And then record a profit from building itself. So be reasonable and add the real cost and stop it at the fair value. That's all.
So now continuing to the borrowing cost during construction, there is a three approach to account for the interest incurred, which is one, capitalize no borrowing cost during construction, two, charge construction with all borrowing costs of any employed, whether identified or not, and then the third is capitalize only the actual borrowing cost incurred during construction. So the IFRS requires the third approach, capitalizing actual interest with modification. The consistency also with the historical cost. The capitalization is considered with three items, which is qualifying asset, capitalization period, and amount to capitalize. Also, IFRS is using the two part, which is just construction with all borrowing costs of an employee. So, before I was talking about the borrowing cost during construction, we have three approach, which is qualifying asset, capitalization period, and amount to capitalize. Qualifying assets is asset must require a substantial period of time to get them ready for the intended use or sell. So there's like a qualification that need. So the asset will be intended to use or sell. The example is like one asset that are in use or ready for the intended use. And the second one is inventory that are produced over a short period of time. And the second one is capitalization period. It's a period of time during which a company capitalizes borrowing costs. It starts when 1. Expenditure for the asset are being incurred. 2. Activities that are necessary to get the assets ready for its intended use or sale in progress. And the third is borrowing cost is being incurred. And it ends when the asset is substantially complete and easy for its intended already for its intended use. And then the last one is amount to capitalize. It depends on whether there is a specific debt that being incurred to fund the project or that is being funded from the general debt obligation. So the capitalizer of or like more lower is one actual interest cost incurred or two avoidable interest, which is the amount of interest cost during the period that a company could theoretically avoid if it has not made expenditure for the assets. The lights, right? So now we will talking more about that. So how to amount we use a vague effort accumulated expenditure, which is accompany vague the construction expenditure by the amounts of the time fraction of the year or accounted period that it can incur interest costs on the expenditures. So how to calculate this is by this is the example. We do expenditure date at the March 1st, and then we need to calculate the March until the end of the period, which is December. So from March to December, there is a 10 job, and then we need to calculate the capitalization period, which is 10 divided with half, or it's like called as a 10 per 12, something like that. And then we need to multiply with the amounts in the amount. This example, in the March, we pay 300,000, and then the capital spirit is 10 per 12, so the effort amount will be 250,000. So it's being multiplied. And also the interest rate, which is letting appropriate interest rate. There is a one way that effort accumulated expenditure less than or equal equal to any amount borrowed specifically to finance construction of the assets using the interest rate incurred on the specific borrowing. So if there is a less or equal use incurred on the specific borrowing, but if the weighted average accumulated expenditure is greater than any debt incurred, especially to finance construction, use the interest rate incurred on all other outstanding debt during the period. It's like example here. This kind of amounts interest rate is called capitalization rate, which is multiply the the interest of your borrowing, and then plus with another borrowing that you have, then you have the capitalization rate. And also there is a two type of capitalization rate, which is there is a type of debt, which is specific debt and general debt, and there's a different of computing it, and you need to compute it in one by one. So if you are using the both of specific and general, you need to compute it one by one.
So I will explain about valuation of property, plant, and equipment. So as with other assets, companies should record property, plant, and equipment at the fair value of what they give up or at the fair value of the asset received, whichever is more readily evident. However, in the process of asset acquisition, sometimes obscure fair value. For example, if company buys land and building together for one price, how does it determine fair value for the land and building? We examine this type of accounting problems in the following section. The first one is cash discount. So when recording planned asset, the purchase price should be reported net of all available cash. Discount regardless of whether they are taken or not, because the discount represents the asset through cash equivalent cost. Will any failure to claim it is viewed as a management inefficiency rather than a part of the asset value. The second one is deferred payment contract. So companies frequently purchase planned asset on long-term credits contract using notes, mortgage, bond, or equipment obligation. To properly reflect costs, companies account for asset purchase on long-term credits contract at the present value of the consideration exchanged between the contracting parties at the date of the transaction. For example, Greenhouse Company purchased an asset today in exchange for a 10,000 zero interest-bearing note payable 4 years from now. So the company would not record the asset at the $10,000. Instead, the present value of the $10,000 note establishes the exchange price of the transaction. So assuming an appropriate interest rate of 9% at which the discount this single payment of $10,000 4 years from now, Greenhouse record his asset at $7.08430. So when the interest rate is stated, or if the specified rate is unreasonable, the company imputes an appropriate interest rate. The objective is to approximate the interest rate that the buyer and seller would negotiate at arm's length in a similar borrowing transaction. In inputting an interest rate, companies consider such factors as the borrower credit rating, so the amount and maturity date of the note and prevailing interest rates. The company uses the cash exchange price of the asset acquired, or if determinable, as the basis for recording the asset and measuring the interest element. To illustrate, for example, Syarah AG purchased a specially built robot spray painter for its production line. So the company issues a €1,100 5-year zero interest bearing note to Bulgari Robotic for the new equipment. The prevailing market rate of interest for obligation of this nature is 10%. Syarah to pay off the note in 20,000 euro installments made at the end of each year. Syarah cannot readily determine the fair value of this successfully built robot. Therefore, Saturn approximates the robot value by establishing fair value or present value of the note. Entries for the date of purchase and date of payment plus computation of the present value of the note are that are already shown in the PPT. So the date of purchase and then the equipment is $75,000 because the interest expense in the first year under the effective interest approach. So the entry at the end of the second year is like that. If already being recorded like that, so if Sutter did not input an interest rate for the deferred payment contract, it will record the asset at an amount greater than its fair value. In addition, Sutter would understand interest expense in the income statement for all period involved. So let's move to the next. The next is the third one is lump sum purchases. So a common challenge in valuing a fixed asset arises when a company purchases a group of assets at a single lump sum price. When this occurs, so the company allocates the total cost among the various assets on the basis of their relative fair values. To determine fair value, a company should use valuation techniques that are appropriate in the circumstance. So in some cases, a single valuation techniques will be appropriate. In other cases, multiple valuation approach might have to be used. To illustrate, so in the PPT I already show, so Northern Homes Inc. decided to purchase several assets of a small heating concern, Comfort Heating, for $80,000 Comfort Heating. In the process of liquidation, its assets sold are as follow. So the follow is the book value is the book value for inventory. The book value is $30,000 and the fair value is $25,000, and then etc. So Northern Homes, and then there is the allocation. The next is the allocation of purchase price. It's like we divide the total of the fair value with the, like for example in the inventory, with the inventory fair value cost, and then we multiply it with the 80,000, and then we got the valuing fixed asset. And then the fourth one is insurance of shares. So when company acquire property by issuing securities such as ordinary shares, the part of stated value of such shares fail to properly measure the property cost. If trading of the shares is active, the market price of the share issued is a fair indication of the cost of the property acquired. So the shares are a good measure of the current cost equivalent price. So for the example, Upgrade Living Co. decide to purchase some assets at Staten Land for expansion of its carpeting and cabinet operation. In lieu of paying cash for the land, the company issues to the land company 5,000 ordinary shares, or per par value is $10. That have a market price of $12 per share. Upgrade Living Co. records the following entry is like that. So the land is the shares multiplied with the market price per shares, and then you got the share capital and then share premium. So if the company cannot determine the fair value of the ordinary shares we can exchange it based on the market price. So it may estimate the fair value of the property. It then use the value of the property as the basis for recording the asset and issuance of the ordinary shares. So we're gonna next to the next slide. And then the last, we're going to talk about the exchange of non-monetary asset. So the accounting treatment for non-monetary assets exchange is a subject debate with different views suggesting either books values to avoid gain or loss recognition, or differing gains in specific scenario. However, the standard approach is to record this exchange based on the fair value of the asset involved, whichever is more clearly evident, leading to the immediate recognition of gain and losses. So So this method is preferred because most exchanges have commercial substances, meaning they reflect a real change in the company economic positions that should be accurately reported. So the first one is meaning of commercial substance. So as indicated above, fair value is the basis for measuring an asset acquired in a non-monetary exchange. If the transaction has commercial substance, an exchange has if the future cash flows change as a result of the transaction. That is, if the two parties' economic positions change, the transaction has commercial substance. So the second one is the exchange loss situation or has commercial substance. When a company exchange non-monetary asset and a loss result, the company recognizes the loss if the exchange has commercial substance. The rationale: companies should not value asset at more than their cash equivalent price. If the loss were deferred, asset will be overstayed. And then the next one is exchange gain situation or has commercial substance, which a non-monetary exchange has commercial substance and a gain is realized. So in such a case, companies usually report the cost of a non-monetary asset acquired in exchange for another non-monetary asset at the fair value of the asset given up and immediately recognize as a gain. The company should use the fair value of the asset received only if it is more clearly evident than the fair value of the asset given up. And then the last one is lack of commercial substance. When an exchange of non-monetary asset lacks commercial substance, meaning the company economic position remains unchanged, any resulting gain is deferred rather than recognized immediately. So the deferred gain is used to reduce the basis or reported cost of the new asset, which can be calculated by either subtracting the gain from the new asset fair value or adding any cash paid to the book value of the old asset. So consequently, the gain is only officially recognized when the new asset is eventually sold, ensuring that financial statement reflects a change in economic reality only when transaction has true commercial impact. So in the next slide, we'll be presenting by my friend.
Now I'm gonna explain about costs subsequent to acquisition. It's after installing plant assets and retiring them for use, a company incurs additional costs that range from ordinary repairs to significant addition. The major problem is allocating this cost to proper time periods. After a company buys property, plant, or equipment, it must decide how to handle additional costs related to those items. To record this cost as an asset rather than immediate expense, two rules must be met. The first one is the company can accurately measure the cost. The second one is the company will likely get future economic benefits from the cost. A cost is considered an asset if it improves the item in one of these three ways. One is longer life, two is higher output, three is better quality. The longer life is the cost extend how many years the assets can be used. The higher output is the cost allows the assets to produce a larger quantity of product. The third one is the cost improve the overall quality of the project being made. And we have underlying concept. It's expensive long-lived water waste basket is an application of the materiality concept. Then we have major types of expenditure. We have four. The first one is addition. Addition is increase or extension of existing assets. So the companies is capitalize any addition to plant assets because a new asset is created. And second one is improvement and replacement. A company substitutes one asset for another through improvement and replacement. We have improvement. The improvement is the substitution of a better asset for the one currently used, and the replacement is a substitution of a similar asset. If the expenditure is increased, the future service potential of the asset, a company should capitalize it. The company should simply remove the cost of the old asset and relate depreciation and recognize a loss, if any. It should then add the cost of new substitute asset. And the third one is rearrangement and reorganization. It indicates earlier a company may incur rearrangement or reorganization costs for some of its assets. The question is whether the costs incurred in this rearrangement or reorganizations are capitalized or expensed. And the last one is repairs. We have two repairs. The first one is ordinary repairs. Ordinary repairs is companies make ordinary repairs to maintain plant assets in the operating condition. It charges ordinary repairs to an expense account in the period incurred on the basis that it is the primary period benefit. If major repairs occurs, several periods will benefit. And the second one is major repairs. It involves large expenditure that extend the useful life of an asset. The cost of major repair is capitalized rather than being charged to expense as incurred.
Next, we will discuss about disposition of property, plant, and equipment. Disposition of plant, property, and equipment means a company removes or disposes of its fixed asset. There are several ways a company can dispose of assets, from sale, exchange, retirement, abandonment, and involuntary conversion. Before disposing of an asset, the company must first record depreciation up to the disposal date. After that, the company removes all related accounts from the books. When a company disposes of an asset, it may experience either gain or loss. First, the company calculates the book value using this formula you can see on the slide. And then if the selling price is higher than the book value, the company records a gain. If the selling price is lower than the book value, the company records a loss. The gain or loss is reported in the income statement. Now, let's look at an example of sale of plant assets. A machine has a cost of 18,000, annual depreciation of 1 and 200, and it has been used for 9.5 years. The machine is sold for 7,000. Before recording the sale, the company must first record depreciation for the last 6 months. The annual depreciation expense is 1 and 200 because the asset is used for only half a year before being sold. So the depreciation expense for 6 months is 6,000. For the journal entries, you can see the first image on the slide. Next, we calculate the total accumulated depreciation. For 9 years is 9 times 1 and 200 equals 10 and 800. And we add the extra 6 months depreciation of 600. So the total accumulation depreciation becomes 11 and 400. Now we calculate the book value. We calculate from total cost minus accumulated depreciation, and the book value of machine is 6 and 600. The machine is sold for 7,000, and then the book value is 6 and 600. To determine gain or loss, we calculate from selling price minus book value. The company records a gain of 400 because the selling price is higher than the book value. For the journal entries, you can see the second image on the slide.
Next, we will discuss about involuntary conversion. Involuntary conversion happens when assets are lost or destroyed because of unexpected events such as fire, flood, theft, tornado, and accident. In many cases, companies receive compensation from insurance companies. The accounting process has two steps. First is record the loss, and the second one is record the insurance recovery separately. In this example, a building is destroyed by a tornado. The building originally cost 6 million and accumulated depreciation is 2 and 500 million. The carrying value is calculated as building original cost minus accumulated depreciation. So the carrying value is 3 and 500 million. Later, the insurance company pays 5 million as compensation. For the journal entries, you can see the image on the slide. The journal entries, May 16, 2022, this entry removes the destroyed building from the accounting records. And the journal entries at March 18, 2023, this entries records insurance recovery.
Thank you for watching this video and bye bye.